Hi there, this is John Thompson, founder and lead advisor at SMPL Mortgage. Today I'm going to be sharing with you what I find to be a really fascinating kind of case study from a real client using a reverse mortgage to substantially enhance their retirement planning. All right, so you don't need to look at me. Let me go through this over here. So here's the scenario, and we call this the home equity IRA stretch. Right. So we have a client in their early 70s. They've got $1.3 million home with no mortgage. They have almost $900,000 in an IRA, but they are spending about $25,000 over their current pension and Social Security income. And the liquid assets they had set aside are just about gone. So they are concerned. Their advisors are concerned about, increasing the tax, because when you need to draw more money from your IRA, you're obviously paying tax on that money, and that can really deplete the account much quicker than maybe originally intended. In this case, taking those required minimum distributions and the tax and spending, well, it's going to run on about 13 years. So it doesn't get them to their end point. They love to be able to age in place. They want to travel, remove stress, and have a plan of contingency. So what do? We put together a home equity conversion mortgage, which is the formal name for a reverse mortgage. We put a standby line of credit in place. They have access to $438,000. They took $100,000 initial cash to deal with some immediate expenses. And then they designed $25,000 tax-free draws. Again, the money you pull from a reverse mortgage is tax-free. It's your asset. There's no tax on it. And then they have a growing line of credit for contingencies down the road. And ultimately, with our advisors, they'll do a year-to-year evaluation if they should draw from the reverse mortgage or from the HECM. So the impact is pretty significant. They can age in place. There's a lower risk of cash flow depletion. They're not going to run out of money unless there's a huge shock. And it's a huge shock. They have this standby line of credit. The stress is reduced while improving their overall lifestyle. So they get more spending power now, and so forth. So at age 95, if we go all the way forward, they've taken $350,000 of tax-free cash flow. They still have a $522,000 line of credit available and $1.4 million in home equity. They're not really depleting the home equity. They still have about $1.4 million in home equity, assuming a 3% rate of appreciation. And just to kind of show you what these numbers look like on a chart and so forth, here are the actual numbers. Here's the $25,000 draws over 10 years. Here's where the line of credit starts at the very beginning, home value. They got $1.1 million in home equity. And here are the numbers at 75 and 85. And all the way at 95, they still have $522,000. That's even after taking the $25,000 over 10 years. You'll see the balance go from 186 here to 644. But the home value at 3% is still growing pretty significantly. Remember, a larger asset grows quicker than, even if the interest rate's lower, so a 3% would be lower than the 5% cost of money, it's going to grow faster. So if you go all the way up to age 95, there's 522 available. They do owe $1.1 million on the mortgage, but the home value now is up to 2.8. So you got $1.4 million in home equity. So pretty cool. So that's all there. And then here you kind of see some other charts showing what it is over time. So happy to help and talk to you about that scenario, and maybe it has application somewhere in your life. Thanks very much for paying attention. Appreciate it.